is that the rise has occurred on relatively light volume. Down here we've got a volume level, and you can see now, admittedly, some of this is light here, heavier here, and then it declines some, but overall kind of a bias toward the heavier volume because the spiders have become an increasingly popular vehicle to use to get stock market participation. But I think what is helpful, and you can see it better, I suspect, in your books than you can up here on the screen, is to note that first of all, the volume was heaviest in the declining period. We had a brief period of somewhat heavy volume in the beginning of the rise, and you can tell between the red and the blue is the volume on weeks that are up, the red is volume on weeks that are down. And you look across and you see the heaviest volume tends to be on balance in the declining weeks rather than the ascending or growing weeks. And that was true, interestingly enough, as we were approaching the top in 2007. You look over here and you see some of the highest amounts of volume were in those periods where the market dipped rather than those periods where the market was going up. Now, that doesn't mean by itself that that's a death knell to this rally. It's just a caution flag. That's about all. You'd prefer to see strong volume in the ascending weeks and the weaker volume in the descending weeks, but that's not exactly what we're seeing so far. In past years at this annual conference, I've typically done a review of the securities markets over the prior year, and we've cut this back now to a shorter total time frame for the whole conference, and so we're not going to do that, but I do want to profile a few decisions that we made over the past decade because they lead logically into the main question of the day, and that is whether we're likely to experience inflation or deflation. Page 4 shows how stock prices have moved over that period, not just of the decade, but really going back into the 1980s. And you've all seen this. This is updated. This is a monthly graph, and we just keep moving it along. The great bull market began really in 1974. That was the low of the Dow and the S&P, and there are some stutter steps in the 70s, but essentially you had more than a quarter of a century rise up to the peak in year 2000. The market obviously peaked on both the S&P at top and the NASDAQ on the bottom in year 2000. And since then, we've suffered 2 horrible declines and 2 very strong rallies. But net of it all, it's a down decade. And it's a very big down decade in the NASDAQ. In fact, the Wall Street Journal profiled this as the worst decade in U.S. stock market history. And those who have been coming to our conferences for a great many years know that we've been largely negative on heavy stock ownership over that entire decade. We started warning about valuation extremes and debt and derivative explosions at the end of the 1990s, which was right in here in this period leading up to the peak. We're starting to see very clearly what happens when debts and derivatives get too high. But for Abu Dhabi, Dubai would have defaulted on bonds a few months ago. And but for an expected rescue from various members of the European Union and the International Monetary Fund, Greece would be ready to default on bonds coming due very soon. And we know that there are several other European countries in danger of default soon ahead. Fear relating to the unfolding Greek situation has led to a dramatic flight to safety, as you can see on the next slide. You don't have it in your books because this really was born of yesterday's action. But it is the 10-year Treasury note yield. And, of course, it goes here. And then all of a sudden, now, of course, this is over a period of about 5 weeks here. But the big drop is right in here. It dropped down just in the last couple of days, and most particularly yesterday, really as a flight to safety. This is a reaction to the fear of what was going on in the world political and financial environments. And it got down to 3.4% on the 10-year. I saw it this morning as low as about 3.36. I don't know where it was when I left. I didn't check it again. But it's been bouncing around a little bit. Most people don't feel great long-term confidence in the United States because of the runaway budgets that we've built up now with our rescue efforts. But we're really being looked upon as the flight to safety destination still because we're the best of a bad lot. Now, that's kind of damning with faint praise when you think about it. They're coming to us with the massive budget deficits we have because we're better than the other guys. Wow. If you look, now the next page in your books is the longer-term fixed income picture on page 5. We update this every day, and so this is a graph that most of you have seen a number of times. We've basically been in a 3-decade decline in interest rates, obviously with a lot of, I mean, when you're looking at 30 years there, some of these moves, though they look brief, took a couple of years perhaps. And so easy money's been made in bonds at least over a period of 30 years. It's been a lot tougher over the last year and a half or so since we had a low of about 2% down here on the 10-year, and then it went up to 4 a couple of times, and now it's still about 3.4. So it's not been an easy place to be in government bonds over the last, let's say, year and a half or so. But what many people don't know is that if you take the 4 decades preceding this peak, which is the very early 1980s, 1981, you had a mirror opposite of that. You had rising interest rates from about 1941 up to 1981. And in that time period, the return on a reasonable composite of long and intermediate government and corporate bonds would have given you, at best, 3% per year, maybe just something in the high 2s. That's for 40 years. In that same time period, inflation was about 4.3% per year, so you lost money owning bonds, whatever kind of bond portfolio you owned, and you lost money to keeping money in short-term cash for 40 years. Cash would have given you roughly 1% per year more for 40 years than owning bonds. It's been one of the reasons I have derided the policy-making approach that most institutions employ now, mandating a certain amount of bonds in the portfolio. I said, come on, guys. I mean, would you have done that if you had any possibility of having cash outperform bonds for 40 years? Of course not. But people know this 30 years. They don't know this 40 years. And so now, even with rates down here at 3.4 on the 10-year, obviously there's a heck of a lot more room for rates to go higher than to go lower, and yet many people, many institutions still mandate bonds in the portfolio. And that's not to say that bonds won't be successful. They might. Maybe rates will go lower from here. But on a risk-reward basis, it's a tough proposition. Because if you're wrong and rates go up, you could lose a heck of a lot more than you make if you're right and rates go down. So, tough environment. If we get inflation, and this ties a little bit into what we will be talking about in the primary part of the talk, if we get inflation and interest rates rise, which would normally be the relationship, all but inflation-indexed bonds will probably do very poorly. If we get deflation, government bonds should do pretty well. But municipal bonds and corporate bonds, except perhaps for the most pristine credits, will probably do very poorly. So you're in a situation where if you get inflation, almost all bonds are going to lose. If you get deflation, probably your only real safe